Hey guys, and welcome to the Finance Now podcast. This podcast is purely for informational and educational purposes, and it's my way of sharing my knowledge, research, and opinions with you. I'm Anurag Birla, and earnings season is back. So this week, I wanted to talk about earnings of, some of the big banks that came in last Friday and earlier this week, and then also the earnings of Tesla and Netflix, respectively, two companies that I love, and two companies that had some surprises and, some results that, perhaps we were expecting as well. So I wanted to start with the banks. I mean, given the banking crisis earlier this year and, obviously the cautious macroeconomic outlook of the economy going forward, I thought it would be good to look at, the likes of some of the biggest banks, including JP Morgan, Morgan Stanley, Bank of America, and Goldman Sachs. I think it's just on a personal level. I think it's also because I'm quite interested in opening up a position with one of the big banks, and I wanted to do a bit of a deeper dive into how their quarters went, respectively, and what the situation looks like for them going forward. Speaking of JP Morgan, I'll start with them first. They released their earnings last Friday. Shares were up 2%. They had a better than expected Q2 earnings. As you know, the company did benefit from the higher interest rates and better than expected bond trading. So the earnings came in at $4.37 a share adjusted versus $4 a share, which was the estimate. Net income surged 67%, or $4.75 a share, but when you exclude the impact of the First Republic acquisition, so I guess that's what the adjusted part means, earnings were $4.37 per share. Revenue came in at $42.4 billion versus the estimated $38.96 billion, so beating revenue comfortably. That rose 34%, which was fueled by a 44% jump in net interest income to $21.9 billion, almost $22 billion, which was about $700 million over analyst expectations. That makes sense, given the higher interest rates. Their net interest income was higher. If we break down, some of their strengths a bit more from this quarter, retail banking was their main source of strength. Profits from retail banking surged 71%, while revenue grew 37%. Better than expected trading and investment banking activity was also another one of their strengths. While it wasn't optimal, it was definitely better than expected. And I think if we look at that a bit more deeply, all of fixed income trading, equity trading, and investment banking revenue topped analyst estimates, which is encouraging. I mean, I think analysts would have expected the banks to suffer more, JP Morgan to suffer more, given the economic pressures, macroeconomic pressures, and the banking outlook for the rest of the year. But it is encouraging to see how resilient JP Morgan has been through this period. So while consumer banking was much stronger, investment banking did show some signs of growing strength as well. I think a big thing for them this Q2, as I briefly mentioned a bit earlier, was the First Republic acquisition, and the added assets from First Republic and that acquisition proved to be of some healthy benefit to JP Morgan as well. Moving on to Morgan Stanley, another bank that, beat estimates, but this time their beat was driven by record wealth management revenue. Slightly different to what we saw at JP Morgan. Morgan Stanley shares rose more than 6%. Earnings came in at $1.24 a share versus $1.15 per share, which was what was estimated. Revenue came in at $13.46 billion versus an estimated $13.08 billion. Revenue climbed 2%. Profit, however, declined 13% on lower trading results from a year ago, and layoffs that also cost the company about $308 million. So I guess we saw, profits grow for JP Morgan, but for Morgan Stanley, they've declined a decent amount. That said, wealth management revenue rose 16% on higher interest income. institutional securities business posted an 8% drop in revenue driven by declines in trading. Fixed income trading was well below what was estimated, while equities trading beat estimates. Investment banking revenue was essentially unchanged from last year, but overall, I think that segment of the business definitely suffered due to some of the macroeconomic pressures that would have led to a decline in general client trading, institutional trading. James Gorman, the CEO, he mentioned earlier this year that he's going to be stepping down, which triggered a massive succession race for the bank. He did mention that they are evaluating 3 candidates as CEO, and that, post his time as CEO, he will remain an executive chairman at the company. Gorman remained positive as well when asked about the forward-looking statements. He mentioned that the outlook of the interest rate discussion, he was pretty positive on that front, saying while we may not be at the end, we're definitely closer. And, he also remained bullish and positive on Morgan Stanley's ability to grow in various different market environments, which was encouraging for some analysts. And I think that was sort of the main catalyst in the 6% rise of the share price. Bank of America. Now, Bank of America joined the other banks in beating analyst expectations and raising guidance as well. Shares climbed more than 4%. Now, again, in light of, higher interest rates, as we saw with the other two, they managed to reap more interest income. Earnings were 88 cents a share versus an expected 84 cents a share, which earnings actually rose 19%, and revenue came in at $25.33 billion versus an expected $25.05 billion. Revenue climbed 11%. That was mainly driven by a 14% increase in net interest income. Their Wall Street operations were solid. Fixed income trading jumped 18%, so quite a big jump, while equities trading slipped 2%, not ideal. Bank of America shares haven't done very well this year as a whole. They've been down about 11%. And to be honest, they were expected to be the biggest beneficiaries of rising interest rates just because of how large their deposit base is. I think it's the largest in America. But that hasn't been the case. I mean, JP Morgan looks stronger in terms of their earnings. So if I had to do like a direct comparison and kind of look at forward-looking statements, I know both had pretty good quarters, but I'd be leaning towards the JP Morgan side of things if I really had to pick a winner right now. That said, I'd like to move on to the fourth bank I wanted to discuss on this episode, which is Goldman Sachs. Of the 4 that I mentioned, Goldman Sachs had by far the weakest quarter. Now, as expected, given its focus on investment banking and deal making, and despite the weak earnings, shares were fairly flat. I think by the end of the day, it rose, about 0.5% or 1%, something like that. But if we look at their investment banking revenue, that declined by about 20%. Trading revenue dropped 14%, and overall profit dropped a whopping 58% year over year. Morgan Stanley also saw a drop in profits of the other banks, but Goldman Sachs was the biggest of the large names. They had a very underwhelming quarter as they, also failed to meet analyst expectations. And if I may be honest, analyst expectations were already pretty timid. It has been their worst quarterly profits since 2020 after the COVID-induced recession. Equities trading was up 1%, but fixed income trading down 26%. I think this quarter and, these results kind of put David Solomon, who's their CEO, under a lot more scrutiny than he's already been. Goldman Sachs have had a shrinking consumer business. He did mention that investment banking activity has been at 10-year lows, and this is not going to be normal going forward. He also mentioned deal-making activity has been looking better than it has before earlier in this year. He mentioned it's been looking better these last 6 to 8 weeks. But, they face trouble. I mean, Goldman made the decision to wind down consumer lending operations just to free up capital and, devote more time to focus on core strategies. they're trying to sell Green Sky, which is their buy now pay later business, and they're also trying to end their partnership with Apple. So it looks like turbulent times for Goldman. David Solomon is obviously under a lot of pressure, and I think, investors want to see more stability, more, sustained growth, and just a better outlook from Goldman, as they have been a powerhouse over the last decade or so, and it's something people would look at Goldman's earnings and kind of look at the health of the banks. I would think, at least people who don't know much about how the regional banks are doing and how some of the other big banks, I think Goldman's a big indicator for a lot of them. Now, I think looking at this, obviously banks are going through a rough period. Makes complete sense. M&A deals, while they may tick up a little bit in the second half of the year, it's a bit too early to say, and I wouldn't be too hopeful on that either. We're also probably not at the end of interest rate increases. The macroeconomic conditions are still somewhat uncertain, and while everyone's become more hopeful about a soft landing, I think a lot of people in the banking industry, including Jamie Dimon, did mention that tread carefully. Client activity for banks may remain slightly lower this year, so we shall see whether these optimistic forward-looking statements are warranted or not. Moving on from the banking sector, I wanted to talk about Tesla as well. Now, Tesla is obviously a company I've spoken about multiple times on this podcast. It's a company I like. It's a vision I'm fully aligned with, and one that, I want to see come to fruition. But the stock tumbled about 10%, facing its worst day since April after releasing their Q2 earnings. While revenue and earnings beat expectations, I think that was already priced in. It was very much expected. Concerns over margins overpowered the good news. It makes sense. And if I'm honest, before their earnings took place, I sort of expected their stock to drop. Obviously not 10%, but I expected, maybe a 5% drop, just given the run that the company has had this last quarter, this last year. I thought, a lot of optimism was priced in, and analysts would be looking at a reason to see the company, not meet expectations versus see what the company are actually looking to do going forward. Gross margins were, as I mentioned, lower than expected, came in at 18.2% versus what was expected, 18.8%, and operating margin fell to below 10%, nearly 5% lower than what it was a year ago. Now, Tesla still maintained their target of 1.8 million deliveries this year, but Elon Musk also signaled that Q3 production would be slightly down because of summer shutdowns for factory upgrades. Going back to the margins and the concern about margins, I see why it's a worry, of course. I think given Tesla had record and industry-leading margins, the fact that they're now lower is almost half, actually. I think at one point it was 30%, now it's 18.2%. I'm not sure why it's a surprise, though. I think macroeconomic headwinds, given all that's happening with consumer spending and how people are being more careful with their money, it makes sense to cut prices in order to drive demand. And if the opportunity autonomy presents is as big as we think it is and as big as Elon Musk says it is, this really won't matter that much. And he's pretty clear about that. I also gained some sort of comfort knowing that he's not worried at all about the margins. He's so focused on grabbing customers and just acquiring that wide customer base and delivering cars that right now it's a volume game for him. It's not necessarily a margin game for him. And honestly, I'm on board with that. He seems like he knows, I guess, the full capability of FSD, full self-driving, and what that might mean to Tesla. And I think, as a Tesla shareholder, that's something I'm holding on to. That's a big reason. And I think the day my trust in that vision wavers is the day I'll reconsider as to whether I want to hold the stock or not. Cybertruck production is expected to also begin later this year. And apparently, according to Elon Musk. I would take this with a pinch of salt because he is known to inflate certain things at certain times, but according to him, demand is off the hook. It won't be an issue. They also have close to 50,000 supercharger connectors and over 5,000 stations globally, and they are in early talks to license their FSD software to a major OEM, which could be big for them. Looking beyond their automotive segment, their storage segment saw good growth and margin expansion, which is a huge positive for them. As I've said earlier, I believe their energy storage and generation segment is a very overlooked part of their business. I do expect it to grow rapidly over the next 5 to 10 years. And just overall profitability-wise, Tesla beat expectations, which is good. I mean, it's promising. If the biggest concern is a margin slowdown, and if that caused a 10% drop in price, I'm okay with it. I'm not too phased. I'm going to continue to hold the stock, and I'm going to have faith in how the rest of the year is going to go. And hopefully they can achieve full self-driving soon, and we can see the opportunity that autonomy presents from then. The final company I wanted to talk about that had earnings this week was Netflix. Now, much similar to Tesla, Netflix's stock tumbled as well, nearly 10%, about 8.5% after their Q2 earnings, as sales from Q2 and revenue guidance for the third quarter missed estimates. Again, this is one of those companies that, it dropped. And actually, for me, I'm not a Netflix shareholder, but in my head, this presents somewhat of a buying opportunity. They mentioned that revenue acceleration and growth would take time for their company and their business. Spencer Newman, their CFO, said revenue growth will be driven by a combination of pricing, volume, and new revenue streams like ads. But, those initiatives will take time to mature. He also mentioned that ad revenue isn't going to be a big contributor this year, and that, it would be much more of a gradual build. That makes a lot of sense. I think with Netflix, the main thing that caught me off guard, and I guess many surprise of the quarter, was the number of subscribers they managed to add. And I'm actually surprised the stock dropped 8.5% after knowing that piece of news. Estimates for subscribers added were 2.1 million, but in reality, they ended up adding close to 6 million, 5.89 million, and that's largely due to their password sharing crackdown. They have forecasted a similar gain next quarter as well. That's so counterintuitive because I think many would have thought with their password sharing crackdown, they might actually lose subscribers or add far less subscribers than what was expected. But people have caught on and adapted to it pretty quickly. And while growth for Netflix may be slow, they are one of the best, if not the best positioned streaming service at the moment in the media business. They are laser focused on increasing profitability and free cash flow, which is so valuable to investors specifically. Maybe not so much to the consumers. I mean, if I look at it as a consumer and I look at the whole ad tier thing, it's irritating. It seems like we're going back in time and we're just going back to TV, except this time it's on our laptops and on the internet. But as an investor, you look at it as just another opportunity for them to monetize, for them to make more money and hence grow. And I think it's very encouraging signs for Netflix. The entire media and entertainment business has looked tough. Actors strike, writers strike. It all means that these companies, including Netflix, will not be able to produce maybe as many TV shows and productions as they would have liked. But for Netflix specifically, what that means is that they'll have even more free cash flow for the end of the year, which is insane. I mean, they already have a good amount of free cash flow. Not being able to produce all their projects would mean they just keep more of the cash. And I would say for Netflix, they had a very tough last year, but I think the company is back on track. I think they've rerouted, and I think growth looks good. Albeit slow, it looks good. It is a company I am very interested in, probably one I'm going to open up a position in soon, one that I have a lot of belief in. whether it's them growing as, the largest streaming service in terms of subscriber count and monetizing their ad revenue, or whether it's also making some acquisitions and expanding their, business lines. I think the direction they're heading in, the leadership they have, Netflix is in good hands, and it's definitely a company I would love to own going forward. I would like to conclude by saying, please, 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 as I always mention, do your own research. Don't take anyone's opinions, to heart, and don't base your buying or selling judgment solely on someone else's research and opinions. Always look out for yourself, do your own research. I really hope you enjoyed this episode, and if you did, I thank you for listening. I'm Anurag Birla, and this is Finance Now.